Hey, Nitin, welcome back to 2020's TV. Um, Today we're going to talk about the economy, and I think it's going to be a fun topic, touching on a lot of different things, including oil, real estate, stock market. So hopefully that we cover a lot of ground on this, um, and hopefully try to pick out some interesting nuggets for our listeners. So, any big thoughts you want to start us off with on the economy?
Sure, I'm hoping as we have this discussion, we try and make sense of some of the things which don't seem to make sense to at least to me, right? I mean,
Uh,
how's the stock market, for example, not reflecting any of what's going on? How are we going to come out of this, and what is it going to look like in terms of unemployment numbers, in terms of how many people are going to continue working from home, and uh, you know what did the thing with oil even mean? Uh, you know, how does oil cost a negative $37? Like literally, you can get paid to get oil off of people's hands. And what is the commercial and residential real estate going to look like in the near and the long term future? Right? If people are going to continue working from home, companies are not going to need as much real estate. And if the unemployment numbers are where they are, how are people going to afford paying for rents or mortgages? This some sort of a holiday that has been extended to a few of us in mortgages and payments is not going to remain forever. So I think those are the big chunks that uh, to me sound like things that need to be thought through, discussed, or even just kind of try and make sense of.
Yeah, absolutely. I think that's a great point. I think the broader subject. Let's start with the economy and the recession and where we are. March was pretty bad. That's when we started to first see the effects of COVID-19,
Mhm.
and things started to go downhill. But the real impact, it was in April. Most of the economy was shut down. Most of us were in lockdown, so we'll really see April essentially means Q2. So recession dictionary definition is 2 quarters of
Mhm.
GDP decline. So certainly Q1 is going to be down from Q4, and then Q2 is going to be way down because entire month is lost. So we're certainly in a recession. No, there's no argument in that. But now, if we take that and apply it to all of these other asset markets, things don't make sense.
Yeah.
So, I think the first thing we probably need to focus on is the unemployment figures. And, 22 million people, I think, last count, have lost their jobs. Unemployment rate is, close, it's in the high teens, if not close to 20%. Um, so, what are your thoughts on that, and where do you think that's going in the near term? So, over the next maybe month or so, and then slightly longer term.
So hopefully, from the little that I know, a lot of these jobs are uh, things that can just be flipped back on when things start to open back up. Right. For example, restaurants. A lot of people working there, uh, they'll just go right back. Uh, but some of the other jobs that have come about as which have some sort of an indirect impact. For example, travel. Right. The estimates are travel is not going to be anywhere close to what it used to be uh, because habits take 21 days to form, and we've been in this new habit, new normal, for more than 21 days. To go back to what we did, it's going to take a lot of questioning, a lot of reasoning. Why do I need to do this? So people are not going to travel as much for work, for maybe even pleasure. We are going to try and find things that are closer to us, and maybe some mini hotspots of vacations are going to start popping up that are closer to us. And we think about buy local. We might even start vacationing local. And
Right.
again, this is just, I don't know if this will happen, but definitely in terms of work, we are going to start questioning, do I really need to travel for that? And those jobs that will get impacted as a result are probably not coming back, or anytime soon, or not coming back at all. So
Right.
there is definitely going to be more than a recession, more than a slowdown. This whole impetus of, we've talked about how jobs are going to be lost to automation, to AI, to self-driving cars and stuff. I think this this COVID has, brought up another factor for replacing these jobs. I mean, they can get reskilled, retooled, and they can go elsewhere. But I think as a result of this, a lot of the jobs are going to be gone for the most part.
Right. No, I think travel industry is a great example. Same goes for hospitality, hotels and things like that. I don't see occupancy going up,
Yeah.
anywhere close to where it was pre-COVID, in the near term, meaning 6 to 12 months.
Mhm.
So airlines, hospitalities, and then on and on, all the businesses that support that. But quite frankly, even restaurants, I think they're going to struggle because, like you said, habits take 21 days to form.
Mhm.
And we've been eating at home for the last month,
Yeah.
right? Everyone's learning how to cook, everyone's
Mhm.
sort of discovering new skills in the kitchen. People who used to eat out, 3, 4 times a week
Mhm.
now might eat out, once or twice a week. And,
Yeah.
and that will have a huge impact, I think,
Mhm.
in the restaurant industry. Not that I wouldn't compare it to the airline industry, but I think it's still, if you compare it to the baseline, pre-COVID, I think it's still going to suffer. A average fast food restaurant might have 40, 50 employees. Now they might be down to 20, 30. So what kind of impact does that have, right? So we're just sort of compounding one on top of the other, and you go industry by industry, and if you look at all of the jobs that we're losing, it adds up pretty quickly. And we were at about 3.5% unemployment rate
Mhm.
pre-COVID. Right now, we will be at 20%. If we're not there already, we'll be at 20, maybe 20+%.
Mhm.
How many jobs come back? Certainly, a restaurant closed is zero jobs. If once they open, even if it is 20, 30 jobs instead of 50, that's obviously helps. But I don't see us, sub 10% unemployment rate in 2020, for the rest of the year. Um, and that's pretty severe. I don't know if your thoughts sort of line up with that kind of thinking.
Yeah. Just talking a little more about the restaurant industry, I don't remember the specifics, but I was reading that about 40 to 50% of the food, at least in the US, is consumed at restaurants, right?
Wow.
If you look at alcohol, it's closer to maybe 60%, right? So think about, when you go out or you go to work or you go for a meeting, you tend to stop over and have lunch, snack, dinner, a lot of times breakfast. All of that is gone, right? If you're
Right.
not going for a meeting in person, you're not having that food outside.
Yep.
And that compounding impact of, okay, yes, those, you can't go to restaurants even if you were out there, but what if you're not even out there, right?
Yep.
So the demand is going to drop, and as a result, that's going to have a further impact on the business. So today, if there are 10 or 15 jobs out of the 25 or 30 that the restaurant could afford to have, if people stop showing up, what does that do? It furthers
Right.
it down. So I agree that 10% I think is still optimistic, and we want to be optimistic. I i can i would estimate that in certain industries the number is going to be much higher than that.
Right.
So, yeah, hospitality and travel, and yeah, I haven't thought through the whole list, but it's pretty challenging.
Yeah, no, that's a great point that you're making. That when we're talking about going to office less, so when we say instead of going to the office 5 days a week, now I'm going to go 2 days a week. Well, those, every time I used to go to the office, I used to pick up Starbucks on my way. I used to
Mm-hmm.
have lunch with my coworkers. Used to grab a snack in the afternoon. All of those things are gone, or at least 60% of it is gone if I'm only
Mm-hmm.
going to the office 2 days a week instead of five.
Yeah.
So that has a huge impact on all of the surrounding businesses, right? And restaurant is just one. We can even go to another big topic that we should probably touch on is oil.
Mm-hmm.
And if we're commuting less, if we're traveling less, we already talked about traveling for pleasure, but traveling for work also comes into that category. Our consumption of oil is going to be way down. And that affects gas stations, that affects all of the other businesses that transportation of oil and all those things. So again, that has a huge impact on the business side of it. But think about the actual oil price, right? What are your thoughts? I mean, oil collapsing down to negative $37 per barrel is pretty historic.
Look, if I had the storage, I would have bought some, right? But I do want to. I haven't been able to go in and look at this, but when I think about some countries that are net importers of oil, right? Think about India, for example. Uh, I hope they were able to take some advantage. Right? The Indian government was able to take advantage of this situation and stock up. I don't know what the typical reserves are, but hopefully they were able to go in and quadruple or quintuple their reserves, because I mean I can't even process the negative 37, right?
Right.
Getting paid to get oil. And so when I went to, not that we are using enough gas, but I had to do a grocery run. So I went over to Costco and I said, let me fill up. And, I still had to pay for gas. So I was a little bummed about that. But,
Why didn't
one
they
of
pay
those,
me to fill up my tank?
right? So that's what happens when you're retail, you lose out. So you got to play the big game. So, but I was hopeful, I tried. So
Right. Right. No, I mean, there are a lot of other things that obviously go into that calculation, right? So the negative 37 was a future contract for
yeah.
crude oil.
Mm-hmm.
So obviously, then we have to take into account all the refinery services
Mm-hmm.
that go on top of it and things like that. But you're absolutely right in that, the strategic oil reserve, as far I heard, a couple of weeks ago, I read an article saying that US's strategic oil reserves are essentially full.
Mm-hmm.
And, a lot of countries like India and developing countries are probably topping up their strategic oil reserves. But my fear is now that we know that the floor is not, $30 a barrel or
Right.
$20 a barrel. Now the floor is negative $37 a barrel. When you're talking about USO or the crude oil prices, in general, we're talking about the futures contract,
Mm-hmm.
and that obviously can get very complicated.
Yes.
But once you have that as the new norm, the new floor, I can easily imagine people playing with that. And,
Mm-hmm.
now that, we start to look ahead and we start to look at the July future contract that comes due in June, I can certainly see people holding off
Mm-hmm.
and waiting for that price to go to zero or go to negative again before they jump into that market. And same thing with all of the tankers and all of those businesses that are, right now they're saying they're full and waiting till the price goes negative and then trying to go take advantage of that.
Yeah, it's kind of a self-feeding, down to the negatives, because you're right. I mean, when you look at the contracts, right, it's essentially, when you're buying or selling futures, there is an underlying asset to it,
Yep.
but you never plan to buy it, or you never plan to go take delivery of it, right? You're just transacting. But now that this thing happened, and now that all the reserves and all the spots were taken, all the tankers and all of that was taken, there was nothing but you had to go and take delivery of these things, or just say, I'm going to give up, right?
Right.
So essentially, that's what brought it down to the negative. I
Yep.
mean, yes, it only happened for a day, and but the the reasons that brought it to that point, right? The people who have the physical tankers and barrels, that they're not going to be able to sell them, which means they're
Yep.
not going to be able to buy more because they just don't have the space. Right?
Exactly.
So if everyone is waiting, then who's going to, it has
Right.
to be a supply and demand thing.
Yep.
And if there is no demand, the supply isn't moving, and what you have keeps dropping, and that's what brought it to the negative.
Right.
Right? So it is going to be interesting with the producers not stopping the flow. In fact, they said we're not going to slow down, and that's essentially what brought it down from 30 to 20 to 10. And then this whole glut of not having any space just kind of compounded the whole issue.
Right.
So yeah, with the consumption going down in the foreseeable future any which ways, and the production not slowing down, you're right. I mean, this is not getting resolved anytime soon, and I'm still hoping to go to the gas station one of these days and get paid to get my gas. Yes, refineries need to be paid, but hey, there is $37 for each barrel, right? I mean,
Right.
you're making money at $20 a barrel.
Share the wealth.
Yeah, right. If it is negative 37, yeah, take the 20, give me 17, right?
Right. That would be great, right? We'd go out and invest in barrels.
Yeah, let me start something on Facebook. Let me start a campaign on this and get my $17.
Right. That's great. One other comment that I've heard a lot is that on the supply side, why don't they just sort of turn off the spigot for now, keep that oil in the ground, and a month from now, 2 months from now, when the demand starts to go up, just turn that spigot back on. And I just want to address that and say that that's not how oil wells work.
Yeah.
Right? Because these are pressurized oil wells, and you can't necessarily, it's not a spigot that you turn off. One comment that I heard on I believe it was on CNBC, I wish I could remember who the person was, I would credit them, but they essentially said turning off a oil well is akin to bulldozing an office building just because there's no one in it, and it's not like tomorrow you can just say, oh, okay, we bulldozed it last week, let's just reopen it this week. It doesn't work that
There's no
way.
undo. Yeah.
So oil wells, you can't really turn off the spigot. The only way to slow down that flow is essentially stop future investments. And what I'm afraid of, and what people are afraid of, is that if you stop future investments, capex as we call it in business, what happens is right now the supply might start meeting the demand, but when the demand starts to go back up, when people do start traveling, they do start filling up their cars every 2 days, every 3 days, then what happens is that the price of oil is going to shoot up at that point. So instead of $20 a barrel or $18 a barrel when there's no demand, suddenly you're going to end up with $100 a barrel or $120 a barrel, because now there's no supply. We didn't start new wells, and so this is where we're ending up. So that's a fear on the sort of medium to long term, 6 to 12 months. So that's something we have to take into account also, and we have to make sure that we don't fall into that trap.
It's interesting you say that, because I remember reading somewhere that a lot of the CEOs of companies are heavily debating how much travel do we really need, right? As they start thinking about this option of flipping on the video again, talking about habit formation, and we've been in this for more than 21 days now. they are seriously questioning the whole work ethic behind, you know, people want to go meet each other in person, and there is, you know, as humans we've always had the I would say the love for in person and the impact it creates and the leadership style that it, you know, there is a seriousness attached to you showing up in person, right? But now that we've been doing this and doing this effectively, if I remember right, the data said something along the lines of 50 to 60% of the workforce can and will continue to work remote going forward, right?
Yep.
It's still early days. It may shape up to be a different number, but I was surprised that, you know, we've talked about this a little bit before. I was thinking it will be a two-digit number, but 50 to 60% is huge, right?
Right.
Think about the impact of that, you know, the things we just talked about, the travel industry, the restaurant industry, and to oil. So bringing that back to the point, right, that if there is going to be a consistent drop and the, you know, the new normal for the demand is just going to shift by whatever percentage, right? If it's 15, 20, 25%, then what does that mean for the longer term pricing and demand for oil, and how much investment? And I'm sure, you know, the people that are in the deep of this are have run their numbers, have run their analysis on this, and they're planning to that. But the other point of, you know, even if this spigot could be turned off, the repercussions of the whole supply chain, right?
Right.
Even in terms of the cash flows and the jobs and all of those other things is not going to help,
Yeah.
right? So yeah, you know, there is a lot that uh, needs to happen and will happen as things evolve, as we kind of figure out where we settle in on all of these things and what becomes acceptable in terms of work culture, in terms of meeting culture. Am I still serious when I'm meeting with you on a video platform? And
Right.
if the answer is yes, there goes all my, you know, today's the CEOs of smaller and larger corporations spend an inordinate amount of time traveling from one city to another and to another country, and to, you know, imagine the savings from that, just not in terms of dollars for the companies, but also in terms of their time, right, that is being taken away in doing a lot of the travel,
Yep.
and the carbon footprint of that,
Right.
right? Which with all the changes in the climate and, you know, travel being a big part of that, look at the positives, and when we start weighing those two things, it becomes a it becomes something that needs to be thought through a little more deep, in a deeper way.
Yeah. No, absolutely. This is a huge cultural shift, and I think the other industry that I would probably want to touch on is the real estate industry, right?
Yeah.
Like, because like you said, you know, if we can work from home, you know, 60% of the time, then you don't need that office space, or you don't need as much of the office space.
Yeah.
And, you know, models like, you know, the WeWork model, where essentially, you know, even large companies, let's say you have office space for 100 people, but there are 3 companies that have office space for 100 people. So you essentially have it, just imagine it as 3 floors in an office building. But now if, let's say, those 3 companies figure out that, you know, I'm going to take Monday, you take Tuesday, Wednesday, next company takes Thursday, Friday, now suddenly instead of 3 floors, you only need 1 floor, right? And we obviously have to figure out the mechanics of it, and like you said, the culture of this. But you can, you know, the real estate market, if the demand drops by 2/3,
Yeah.
that's a shock.
That's huge. Yeah.
Yeah, exactly. And you know, trying to figure out that kind of you know, repercussions in the real estate market is, you know, significant. So, you know, what are your thoughts on, you know, commercial real estate from that standpoint?
Yeah, real estate is tough. You know, on one end, companies are not going to make that decision because these tend to be a little longer term commitments. So if they already have the real estate, it's unlikely that they're going to say, okay, we are shutting down n number of offices or cubicles within. So it might take a little longer for that to happen, and maybe in that time they do decide that, okay, we've increased hiring, or we're going to repurpose that space for some other thing. So I think it might take probably even the end of this year, or the first 2 quarters of next year to start seeing some impact of those changes. But in the longer term, I do believe that we may either stop building more, or we might start repurposing that real estate for some other things, right? Just to kind of step out a bit of the core concept here with this uh, housing problem, with especially with people on the streets. There has been a lot of discussion around, there is on one end a lot of hotel rooms that are coming onto the market with a large set of development that happened over the last 5 years. And then there is all these older properties that haven't been kept up, right? These budget hotels. And there's a lot of discussion around cities taking over these older properties and putting people from the streets into them, right? So it becomes some sort of a facility for them. Something not along those lines, but something similar could happen with the commercial real estate, right? Where, okay, it's not being used as an office space. Can it be used for X? Could it be a warehouse? Could it be, I can't even think of, maybe manufacturing is coming back. Could that be the space? Or we just demo it and put up something new that'll last for another 20, 25 years. So I think there is going to be a lot of activity that'll come up. May not be all positive, but yeah, things are definitely going to be shaken up in the real estate market.
Yeah. One really interesting thing that I've heard, I want to really pick your brain on this is, Amazon is growing by leaps and bounds. Everyone's trying to get things delivered at home versus going out and shopping. And so one argument was that essentially that last mile delivery, and an interesting concept was that Amazon essentially buying up these local malls and using them as sort of that last mile delivery. So imagine a huge truck pulls up to the local mall, a space that's akin to like maybe a Macy's or something, dumping their truckloads of things in there, and then little robots from going from there to that neighborhood, that town, and making those individual deliveries. So that was sort of a really interesting idea, of repurposing existing retail space into warehouse space, essentially, or a distribution center might be a better term for it. Which is, that's essentially that model, right? Repurposing existing real estate for a different use. It'll be really interesting to see what happens in that space, because that short-term dislocation is going to mean the values go way down, but as soon as you start to repurpose that real estate, the values go back up. So that'll I think be a really interesting thing to see going forward.
Yeah, I think there is. If you look at it in that perspective, Amazon has in some ways already done that with the Whole Foods acquisition, right?
Yep.
But then if you also think about the value that a Macy's or a JCP pays for the real estate that they're using, it has a different set of demographics going into it, and they're valuing those properties in a much different way than an Amazon would. Because for Amazon, it's not required for people to come in or walk in, right? If it's a smaller distribution center, they can still afford to be in a cheaper location, even within that neighborhood, right? So they don't have to be in a place with a lot of parking spots. Yes, their trailer needs to be able to come in, but that's essentially it. They don't care for a lot of the bells and whistles that you need when you're doing pure retail.
Right.
So I think some properties might come out better than others, but as a whole, it will still continue to be a downward trend in the somewhat longer term future, till we find alternate uses for these properties without
Right.
too much of a capex.
Yeah. Yeah. No, absolutely. This short-term dislocation is going to be really interesting to see, and um, so I think this sort of loops back into our asset discussion, and things like the stock market, and right now the stock market is sort of an all-time highs, which is essentially it's an asset based on a business that is operating in the economy, and the economy is really at historic lows. So how do you explain the stock market in the current environment? And I think that that'll go with the real estate valuations also, because real estate prices really haven't budged. Even the residential real estate market hasn't moved much. The closings are still happening. Um, so that's a really interesting thing to sort of think about and try to wrap your head around. Have you had a chance to think about that kind of stuff, like what's going on with the valuations in general?
Yeah, I've had a chance to think about it, and I'll say this: if I would have figured out the answers, I would have been on CNBC, or we would have been on CNBC. So,
Yes.
but it does. It tells me a couple of things. One, just wait out for the right opportunities, and it has to. This mix is going to come up with a lot of disturbance is going to come out of this, and that's where we may find some opportunities for the longer term investors to go in and capitalize on it over the longer term.
Mm-hmm.
So have I been able to make sense of it? Absolutely not. But I am looking at cues, I'm looking at others, and I'm looking at people who have done this a few times in the past. Even though this one is a completely different ball game, there are some cues that we can borrow on from history that may guide us as we start making some sense of this over the shorter and the longer term.
Right. No, I think that's. I think you nailed it. It's really not. It doesn't make sense, and it really needs a different kind of thinking. And what I've been trying to do is slightly different approach, and is that trying to think through sector by sector. So if you just look at real estate, generally, the closings are, somewhere between 60 to 90 days, or even maybe 120 days from when you go into contract. So if you bought a house, if anyone has bought a house, that initially you go into contract, there's a long process. You have to get a mortgage and all those kinds of things. And then you close on average about 90 days after that. So the closings that are happening now, quite possibly those contracts went into effect, pre-COVID. So that might explain why the closings are still happening. The valuations haven't really shifted, is because you're still looking at pre-COVID market. So then, you can expect to see a lot of, once people realize this, once buyers realize this, a lot of sort of contracts start to break, and that number starts to go up. In the stock market, I think people are analyzing, or not analyzing, the individual companies, but hoping for the government stimulus to sort of guide them through, right? Because that's a pretty significant number. I think the direct stimulus has been in excess of 2 trillion. Fed's probably pumped in another 4 or 5 trillion. So we're getting up there, and so the valuations are not really based on the fundamentals or what the businesses are doing. The valuations are really based on the excess liquidity that is coming into the market. Having said that, that's going to dry up at some point, right? We might get a second round of funding. We might get additional activity from the Fed, but that only takes you so far. And I suspect that as we get closer to the election, that's going to start to that's going to sort of slow down at least. Uh,
Yeah.
so then analyzing each market individually is really interesting.
Yeah.
Have you sort of tried to think through that?
Yeah. So, in terms of real estate, you're right. I think there's definitely some uh, momentum coming into this, that of contracts that people were already in, and they're continuing to honor those. But as people get uncertain about their jobs and what's coming next, they're not getting into newer contracts. The other piece of it that is very interesting to me is the the investors that invest in residential properties, which are not making rents as of right now, right?
Hmm.
With tenants getting out of jobs, and if we look at the American household income, and where when you're looking at 20-25% of people not making an income, they're either filing for unemployment, or the ones that are worse off, that have lost a significant number of hours but haven't been laid off, and they can't
Right.
access either of those resources, and they're unable to make their rents. And the states have put in this notice to investors that you can't kick them out, right, for good reason. So bottom line is, their assets are not making any income.
Right.
And so on one end, there will be some investors that, lacking the liquidity and the cash flow, will want to put their assets for sale. And as that happens, and happens more, the supply demand thing will kick in and the prices will drop. On
Right.
the other end, if you have a home and you're not able to continue to pay your mortgage once the banks lift the moratorium on the payments, but you haven't got your job back, we're going to start seeing some closures or exits of people that want to put their homes on the market. And that demand slowing down and the supply going up is going to result in another drop on the single family residence market. Now,
Right.
coming down to the stock markets, and yes, the stimulus money is helping. We have 2 months of essentially companies not having any payroll expenses. But yeah, my thought is, past November, I think we're going to see interesting times once the elections have been you know, decided. I don't know what that market and that economy is going to look like, but yeah, it's purely speculative at this point. It's going based off of sentiment, which I still don't get, because the sentiment is as negative as it ever has been.
Right.
But the fundamentals are not there. The sentiment is not there, yet the market is there. So yeah, it's a mystery.
I think one thing that I keep thinking back to is in the last downturn, 2008, 2009. What happened was, because of at the time we had the first stimulus bill, if I remember correctly, was somewhere in the $700-800 million range, and then subsequently
Yeah.
we probably injected another $1.5-2 billion. So I mean, pretty much where we are right now. But what ended up happening was, the inflation didn't go up. People didn't end up with more savings or things like that. All of that money essentially went into assets, and we ended up with inflation in asset pricing. So the stock market went up, real estate prices went up. Which at the time made sense, because it was really a real estate recession. So, or real estate downturn.
Led, yes.
So we sort of added to the asset values, which sort of helped us in the recovery. I wonder if that's the thinking this time, that we're injecting in this first round 2.2 trillion. Fed is injecting another somewhere between 4 and 6 billion, or maybe 4 and 6 trillion, maybe even more than that. I wonder if the thinking is that money is really going to go into the assets and asset valuations, instead of helping individuals, and it'll obviously carry them through the downturn. But at the end of the day, where does it end up, right? If it stays in the economy, it continues to circulate, then inflation is an issue. But if it ends up into the assets, and stock market goes through the roof, real estate prices go up eventually after the dislocation is sort of corrected, then the gap between the haves and have-nots goes up, which is not a good thing in the long term. But you still, the inflation is under control. People pretty much end up where they are. Vast majority of the people end up where they are. It's really just the top 1 or 2% that take advantage of that asset value, and the increasing asset valuations. And so that's a interesting thing to think about.
No, that's a very interesting thing to think about and talk about. Is one, I think this whole philosophy of just let's kick the can down the road, right? That's essentially what's the theme here. But also, you talked about the widening gap, and you can see that even now in education, right? And yes, this is a temporary phase, but the people, you probably read about this, is people who don't have access to as much technology or haven't traditionally had access to the tech, or sorry, something popped up on my screen. So people who traditionally not had access to tech are struggling to keep up with the education, right? Because of the lack of tech, but also because some of these folks tend to be lacking on the motivation side, and schools have stepped in and helped with that. But without the teachers missing, and without that motivation at home, the have-nots are getting deeper into that valley, right? And that plus the economic have and have-nots. So all of these things that we are talking about, with the asset classes continuing to grow in valuation, if you don't have an asset, which that's still a big number in the US, which is the leading economy in the world, what does that say about a lot of the developing economies? Right? And to compound that, we know these industries are cyclical, and we've pre-COVID, this was the longest boom cycle we had. And if that continues without a natural sense of having fallen, you're just artificially extending this cycle. And whenever that, the can has to stop somewhere, right? And when it does, what is going to be the result of that?
Right.
I haven't got that far, but it just, again, these are very different times. And I think, we talked about this previously. In a lot of ways, this is like the circle kind of coming back 100 years, right?
Right.
So there is going to be a major shift in a lot of ways. How that shift is going to impact us, some part of it we can figure out. A lot of pieces are still unknown, and they will continue to shift over the next 6 to 12 months till a picture starts to emerge. I don't think we'll still have the complete picture by then, but some sort of a sketch is going to start emerging. And the ones that have the power and the ability and the cash will start hedging their bets in clearer ways down the road. But as of now, it's anybody's guess.
And I think that's a perfect way to sort of end this conversation, that it's anybody's guess is absolutely right. And I think that's what's going to make the 2020s so interesting. That loop you said, 1920s were really, amazing times. Looking backwards, I think that's essentially what we're in for in the 2020s. And all of these things, I think, as we continue to have these discussions, and as these, markets start to evolve, it'll be interesting to sort of wonder what the next steps are, and figure out our way. So I hope we can continue doing this, and I hope our listeners keep coming back and participating in the conversation. And so I with that, Nitin, if you want to add anything, I'll turn it over to you. But yeah.
Sure thing. I mean, this is fun. It takes your brain in places where if you're just thinking alone, you don't want to go because it's scary.
Right.
But it's also exciting. And I am glad, as unnerving as it can be, I am glad to be living in this generation, in this era, in these times, where we're getting to experience something that we collectively as a humankind may not have in a while, right? So it's definitely exciting times, and hopefully we come out of this stronger and start focusing on the right things that this pause has given us the opportunity to. And I'm really thankful for this as a whole, and also for having these discussions with you.
Yeah. No, absolutely. And by the way, I'll also invite our listeners to participate in the discussion. Please email us, reach out to us, and let's continue the conversation. All right. So with that, we'll wrap it up. Nitin, we'll talk soon. And catch you in the next episode. Thanks.
Likewise, Dhaval. Have a great one.
You too. Bye.
Bye.